In today's video, I want to talk to you about how you take a loan application that would hopefully get approved and turn into a commission. My name is Zevi Shafran. If you're new to the channel, welcome. I'm an owner of a company called Loanbrook Inc. I'm the broker. A lot of you guys tuned in to find out about loans and maybe about how to get into the loan business. I think in this video, you're going to learn a lot about how you can take an application and really the different pieces that you have to look for, things that I would look for myself when talking to a borrower. So if you're interested in that, I think you're going to get a lot of value out of this video. With that, let's dive right into it. The first piece of the puzzle is actually identifying the personal information. Now, this may sound pretty easy to you, but you know what? A lot of things get overlooked in the transaction simply because there's not enough emphasis on the personal information. And when I say that, I can't begin to tell you how many loan officers I speak to, and I ask simple questions, and they don't know the answers to them, simply because they don't take the time to listen. So if I'm talking to a borrower, I would like to know, is this a transaction for a purchase, refinance, cash out, owner, investor? What are we trying to do here? Are you trying to buy a single family residence, a condo, a multi-unit? There's a lot of things that they're going to tell me that I would really need to know for me to be able to put together a solid file for them. And unless I have that information, it doesn't make any sense to move forward, all right? In addition to that, you're gonna wanna know if they're married or not, if they're trying to do this in their name or is there a co-borrower, is there a trust, do I need a copy of it? So make sure to address all these questions up front before moving on to actually trying to qualifying them, which is talking about their employment and their income. You could ask them approximately how much money do you make every single month or every year, whatever it is, right? And then you could actually back in that payment very, very simply, and I'll show you how, to a mortgage payment. And if they don't make enough money, then there's really no reason to continue to do any of this after that point. So say you're coming into the employment income piece and you ask the borrower, hey, approximately how much income do you make every single year? And they say $100,000. So I know that that's about $8,000 a month. And I also know that guidelines allow me to use potentially up to 50% of this person's gross income to qualify them for housing and everything else they have going on in their life, meaning cars, credit cards, and so forth. Now, I'm not trying to get very technical very quickly, but follow me on this one. Say they make $8,000 a month. You can only use up to 50% of their income for housing and debt. So that means they can only use $4,000. If this person, as an example, is trying to get a $600,000 mortgage, right? I already know in the back of my mind that's about a $4,000 payment. You add in property taxes and insurance on that, it's probably another $800. So I already know that that loan amount is too big for somebody who's trying to qualify with $100,000. At that point, I can basically just stop and say, you know what? Just knowing that information, you're not going to qualify. Because if I can only use $4,000 from your $8,000 in income to qualify you, you're looking for a mortgage of $600,000 where the payment's $4,000, then if I add in anything else, including property taxes, insurance, and then any liability from your credit report, you're just not going to qualify. So that's what I'm trying to say. One step at a time, and you can start eliminating very quickly. So when I do talk about employment and income, I want to know what they do for a living. Are they a wage earner, meaning do they work for a company, a third-party company? It's important, not family, third party, so they can basically give me a copy of their W-2 and their pay stub. And the reason I say that is because if you're dealing with somebody who works for a third-party company as a wage earner, you don't need tax returns. You just need a W-2 to show what they did last year, a pay stub to show that they're in line to do what they did last year, and the fact that they still work there would have a date on that pay stub, most recent, right? You know they're still on the job. So that would take care of that. Now, if they have any other streams of income, as an example, maybe LLCs, maybe holding company, maybe S corporations, maybe rental properties, those are things we would have to see on the tax return. So for that, I would request a copy of the tax returns if I'm trying to give credit for that income. There's also non-taxable income. which is things like alimony and child support, maybe Social Security. So you have to ask these questions. All right, so now we're dealing with the income piece. I just gave you an example showing you how you could literally stop right here if the borrower is not in tune or in line with the amount of income that they make to the amount of loan that they're trying to get. If they are, we move on to assets. Now, assets and liquidity basically tells us how much money does this person have available to put down as a down payment. Let's say the person's trying to buy a house for $700,000 and they're trying to put down 20%. That means that I should expect to see $140,000 in liquidity plus closing costs, right? 20% of 700 plus the closing costs. Now, if that money is not anywhere to be found, we have a problem, right? Because if they're buying an owner-occupied property, they could still get gift funds. So I need to know, are they getting gift funds? Is a part of the money theirs and a part of the money somebody else's? And that somebody else's needs to be a family member. And so if that's the case, no problem, just let me know. But if we're short, when that application goes in, even if they have enough income now, and it goes into underwriting, and there's not enough money to close escrow, we're stopping, right? That file is going to be set aside until we can identify where that money is coming from. So it's very important to identify that the borrower has enough money to close escrow. And then the fourth bucket is you want to figure out their liabilities. Now, granted, we're going to pull their credit report and all those liabilities are going to get populated into the loan application. But keep this in mind. Whatever liabilities they have, whether it's revolving liabilities, which is basically like your credit card, or installment, which is like autos, or maybe they have mortgages, maybe they co-signed for somebody, maybe they have student debt, we gotta add those monthly liabilities, not everything in whole. Meaning, if I owe $4,000 to my credit card, you're not gonna hit me for a $4,000 monthly payment. You're basically gonna hit me for whatever minimum amount I have to pay. So say I owe 200 to this credit card, 200 to this credit card, 200 to this credit card, that's $600. Plus my card payment is another $400, that's $1,000. You take my income that we've discussed, right? You can only use up to 50% of it to include all the mortgages that I'm about to get, which we said was about $4,000 for that $600,000 mortgage, plus $1,000 for my liabilities. So that means that my exposure now, my liabilities are $5,000. If I was to get a $600,000 mortgage with $4,000 payment, plus we're gonna add in my $1,000 in monthly liabilities, and then property taxes and insurance on that, right? So it'd probably be around $6,000. That means that at 50%, my income would have to be about $12,000 a month. That's how you back into it. And I hope that makes sense. I don't want to confuse you. So I'm going to use an example of somebody who makes $100,000 a year, just so we can get an example. So if somebody makes $100,000 a year, they make about $8,000 a month, right? Just using some round numbers. So if I'm using $8,000 a month, then I know that and that's my gross income, I can use up to 50% of that income on a really good day, because depending on the kind of loan that you're doing, I'm using a tax return loan through an agency called Fannie or Freddie Mac, and basically they're going to run an automated system called a DU or an LP, and that's going to spit out an approval. And in most cases, it's going to only go up to 50%, meaning 50% of my gross income, to allow me to qualify, which means the proposed debt, which is the new mortgage, the property taxes and insurance, and everything else that I have listed on my credit report. So if I know that my $100,000 a year is $8,000 a month, and I could use 50% of that, that means that everything that I'm doing, everything, needs to be able to fit into this $4,000 right here, right? I have $100,000, my gross income is $8,000 a month, and everything, I can only use up to 50% of my income to qualify for both housing and debt. So everything needs to fit into this $4,000 bucket, meaning that any liability I have listed on my credit report and any other debt that I'm about to extend for a new mortgage, which will include PITI, principal, interest, taxes, insurance, and homeowner association. And sometimes you even have Melrose, which is a builder's bond. So I hope all that makes sense to you. I just want to put you on the right track. And once you understand this piece, then no matter what platform you're taking an application on, this basically would apply to you being able to look at that application, which actually happened to me many times. And I looked at it and I'm like, something is wrong. It doesn't make sense. The ratios don't make sense. It happens a lot. And then your next phone call is to the borrower to let them know that they don't qualify, when in fact, if you were only able to put it on paper, you would actually see that they may actually qualify. So that's the beauty of being able to look at it just the way that we did. And mind you, if you know what the payment is, all right, if you know what the payment is, as an example, I'm just going to use this example for you because I really want you to get a grasp on this. If I know that the new mortgage, principal, interest, taxes, insurance, and HOA, as an example, is going to be $2,800, and I know that this borrower has $1,000 in monthly liabilities, okay? So that means my housing is $2,800 for no particular reason. All my debt on my credit report, which is installment and revolving, it's all $1,000. It's $3,800. All my debt. If I just divide that, okay, by say $8,000, which is my income, right? You'd probably be right around. I'm just gonna say right around 48%. I don't have a calculator with me, but think about this for a second. You know, you need to be below 50 to qualify. See, so this would work. This would be your housing. This would be your debt from your credit report. And this will be your total debt over your total income, which is 8. And you would qualify because you'd be under 50% in most cases. All right. There's always, you know, different things that are going to come up. But anyways, I hope this helps you. If you have any questions, please drop them in the comments below. I would love to answer them for you. If you're thinking about getting into the mortgage business, it's a wonderful business. It's treated me really well in any economy. And I think that even though rates are a little wacky right now, I personally think that you got to look at things in brackets of 5 or 10 years. And I think anyone who's been in that industry for that long has done pretty well and has been pretty happy. In addition to it, if you're interested, I'm actually building a commercial course. It's called the Part-Time Lender Academy. And I'm going to shoot a link to it in the description below. You're welcome to click and check it out and join the waiting list. It's actually a little bit simpler than doing residential loans, and commissions tend to be just a little bit bigger. So if you're interested in that, something you could do on your part-time, then you're welcome to check it out, all right? I appreciate you being here. You're awesome. And if you have any questions, drop it in the comments for me. Otherwise, I hope to see you on the next video. Thank you for watching. Take care.